Hey, everybody, welcome back. We have Rick Resseguie with us today. Welcome, Rick.
Thank you, George. Good to be with you.
Rick and I have known each other, oh my gosh, 20 years? Has it been 20 years? It's been a long time, Rick.
It has been a long time, and time does fly, doesn't it?
It does. And here's the funny thing. So today, Rick has blessed us with his knowledge, with his presence. He's got a great sense of humor. We're going to talk about commercial lending. We're going to talk about things that you need to anticipate, what you need to look at as you're looking at doing a commercial development. This video was prompted by a number of our clients that are in this process. And Rick so graciously has offered to provide some sage advice and whatnot. And so we'll delve into that a little bit later. But first, Rick, tell people a little bit about you, why you are my guru of commercial real estate loan investment.
Thanks, George. Well, I'm a 47-year veteran of banking, and I started out buying contracts years and years ago from car dealers and moved through the bank and banks, plural, in commercial lending and finance, and ended my career about 7 years ago, managing the commercial division of Umpqua Bank. So, done it all: construction loans, inventory loans, accounts receivable financing, you name it. I probably have seen it if I didn't do it myself, but it's always been about, finding a way for everybody to win. It's get the job done, have everybody kind of participate, feel good about what's going on, and then ultimately getting people what they need. And there's a lot of stuff that goes into borrowing. It's changing on an ongoing basis, but that's part of what makes it fun, is that, the more that you know, the more you can help other people. So that's kind of my background.
Right on. So let's, when we talk about commercial lending, we talk about negotiating terms, which is part of the title. And people are like, well, what do you mean by negotiating terms? George, what the heck are you talking about? It's like residential financing, right? You go out and Freddie, Fannie, FHA, VA, USA, they all tell you what the terms are, what the rate's going to be, and here's your payment. It's normally on a 30-year amortization, and you're solid. Isn't that the case with commercial?
Not at all. Not at all. It's individualized to the point of uh, it comes down to the individual borrower, the individual project, the process that's been already accomplished when you meet with a banker or a lender of any kind, and it's complex because there's the planning, there's the permitting, there's the drafting, the appraisals. And one of the things that I think I want to just speak to very quickly is it takes money to get into the project. It takes money to get the plans drawn up, all of which need to be done prior to going to a lender, because they want to see what the property is worth today, which is kind of a current appraisal. And then they'll want to see what the plans look like that are drawn up and drafted and the cost of those. And then they update the appraisal to let you know and also the lender know what the value is upon completion. So that becomes your loan amount as a percentage of that completion of the project.
Okay. So really at the end of the day, and from a lender's point of view, commercial land development is inherently riskier than lending for stabilized income producing properties like existing commercial pads, existing multifamily, existing apartment or high rise, right? Lenders want to ensure that the project is financially feasible and developer is competent. That is what you just basically covered.
Exactly. And that's why I said money, because it takes money to get into the project. It takes money to get the permits. It takes money to draw up the plans, all of which is on the borrower prior to coming to a lending institution and asking for a loan. And then there's a reserve that we have to plant in there in the event that there's a vacancy. It doesn't fill up as quickly as anticipated. And so there's always a reserve. And again, it kind of comes back to, how much money goes into the project. And here, in talking with you, George, I know that the land that you're talking about are houses that will be demolished, and the land value is probably worth, rebuilding the house on is one value, putting on a high rise is a totally different value, and zoning and so forth, all those things come into play. So those are the things that we want to know about first, and as lenders, and then we kind of take it from there.
But I think you hit that one dead nut on. So let's take these guys through step by step. There's going to be 13 steps. We'll hopefully break these down into simplified versions. But let's just start from the beginning, walk them all the way through the end on what a bank is going to want. This one is, who's the borrower, who's the developer? That's the first question that you normally ask. And in fact, even when we were working on some of our projects that you were helping us with in the past. Okay, hey, tell me about you. What is your experience? Walk them through the eyes of a lender. If you were on the other side of the desk and you said, hey, walk to my office and, go from there.
So the first thing is, what's your experience in doing this? Have you built before? Have you done a project before? And depending on the answer, it can go a number of different ways, but one of the things that is important is that you're contracting with somebody that the bank or the lender approves of. So in other words, if it's your brother-in-law that's built his own house, that's probably not sufficient for a lender, but somebody who is a contractor that does it on an ongoing basis, that's going to be what the lender is looking for. And their reputation, are they reliable? Are they qualified? Have they gotten problems in the past? Those kinds of things. So the person that you pick to actually contract and build the project is going to be important to the bank.
Okay. Let me pop this up just so that let me go. There we go. All right. So you talked about, the experience, and then the next one, a lot of folks want to know, if they don't have a track record, since, some folks are new to the game. Right. If they're new to the game, is that just a deal killer all the way across?
It can be with some organizations. Other ones, here's what I would tell you. The larger the institution, the tougher it is to get a deal through if you haven't had prior experience. And the reason for that is they've just had more experience than some of the smaller banks and or lending institutions, and they have a criteria, and they want you to meet that criteria, or they want to just decline the loan. So in this particular case, depending on experience and so forth, smaller institutions that have more understanding and probably more flexibility are going to work better for constructing a project.
Okay. We've got some financing questions down the way here. Let's head over to our second one. So sure. What is the proposed use of the land? And we talk about, different zoning types, which you mentioned earlier, the consistency and the demand in that market and whatnot. Let's touch base on that just a little bit.
Sure. So whatever the plans are, obviously it needs to be congruent with the zoning. It needs to be congruent with the surrounding areas. So for example, if you wanted to do a housing plat and it's somewhere outside of Mount Vernon and there's not a lot of, other stores or accesses around there, you're going to have to be pretty doggone strong in order to do that. And your loan to value is going to be significantly lower because you're relying on future borrowers renting or buying or whatever the case may be, those houses without the infrastructure that's surrounding it. Similarly, if you're in the city and you're near everything, that makes it easier for a lender to accept simply because it has resale value if something goes wrong. So those are part of the credit criteria that we look at, and location.
Right. Is it safe to say that lenders would potentially, that normally would reject a project, would accept a project if they like what it offers, whether it's location, services, they see the upside in a project? Is that something that a lender will take into consideration on a personal level?
It is, but it's really secondary to the lending criteria, which is, the financial stability of the borrower. For example, in apartment complexes, they may loan 50, maybe even 60% loan to value on an apartment complex, but the reserve is pretty strong, because until you lease it up and it cash flows, you're going to have a pretty strong reserve for that. So to your point, it does make a difference on the use and what the purpose is.
Okay, good. That's something that we have experienced in the past, as far as sometimes, say, hey, yeah, I really like this project, but, hey, I need a little bit more here, to push this through, which makes sense. So, all right, let's hit the next topic here. Is the land entitled? Is it properly zoned? When we talk about, have a plat ready versus just raw land, or hey, have you already gone through the changes to get a binding site plan in certain circumstances, or a preliminary plat? How does that play into what you see as a commercial lender?
So it really depends, George, on, an organization can commit to a loan subject to those things, given that the loan and the property and the advance, the amount, all those things, the qualifications of borrowing are already established. And then you can kind of wait through that process together. But usually there's not a lot of money that goes out to that unless it's secured, by cash. Normally the builder, or not the builder, but the owner, the construction owner, is the one that foots that up front. And that's, I think we mentioned that when we talked about finances earlier on. So,
right.
Yeah.
So based on,
yeah.
do you recommend going through the commercial application process earlier or sooner than later, so that you have the ability to negotiate terms and whatnot?
I do, only because if you can't get financing after you've gone through all of that, you've got a lot of money sitting there that you've spent, and you may end up having to sell that off to somebody else if you can't get it qualified for construction. So, yeah, it's always talk to the lender first about the project, see if you're going to qualify, and it's not a hard yes. It looks like this would work. Now let's move forward with zoning, permitting, that kind of stuff.
Perfect. All right. It just gives people a really good picture of where they at, and the increased equitable value in the property, going from just a single family house, to something
Right.
that might be 4 floors or 8 or 12 townhomes, things along those
Yep.
lines. That all comes into into the picture to evaluate a go or no go, right?
Right. And in some cases, you have to change lenders if there's one sticking point or two sticking points. But what you want to know before you go into that is that you're financially capable of doing it from a lender's perspective.
Which makes a ton of sense, because worst case scenario, you get it to a binding site plan, and you either bring in a partner, or you spin it off, or you just land bank it for a little while, as they tell you, this is what you need today to make this happen. That may happen maybe the following year. You may have that liquidity, or whatever that might take.
Exactly. Yep. Perfect.
All right. So, and I think that's super important, because for people to understand that, again, commercial is a completely different beast than residential financing, that literally everything is negotiable.
It is. And I think the one thing that I would kind of point out here in our conversation, George, is that, like somebody going into business as a restaurateur, the question is, what's your experience? Have you managed a restaurant before? Have you worked in a restaurant before? That background and that experience is really valuable to a lender in finding out whether or not they should even go forward with it. Because if it's brand new, unless you got lots and lots of money, there's a good chance that the lack of experience can impede your ability to get it done.
Okay. All right. And I think that's good feedback. Being a private landlord and owning rental properties, and if you're building rental properties for you, that fits into that same framework.
It does. And then, sometimes you have, a managing partner that has some experience. You have a contractor that's done it before and kind of takes control of the project or whatever it is. And then again, it just takes a little more money, to ensure that it's going to get finished and rent up or, sell or whatever the case may be.
Right. Okay. All right. Let's take a look at our next topic here. What is the project timeline? How long will it take for development phases? When will a property start generating income or sold? And are there any seasonal weather-related issues that come into play? And I think, Rick, I think we've covered some of this, but I think this is super important and a super important aspect of what questions I normally get asked, folks. And I think that this is a great question. So let's take each bullet point. I'm going to leave them up for a little bit. As a lender, your first question is going to be, hey, George, how long is it going to take for you to build this thing? And why is that important to a lender?
Well, they need to know how long of a construction period you're going to have. And then after the construction is done, what's the lease up time, depending on, what it is that you're constructing. And then is there reserves available for that to carry the project? Is it built into the project? Do you have the money to carry the project? Those are the things that are important.
Okay. And I think that's super important, I think, for, some of the folks to understand that they're going to look at construction reserves, meaning during that construction period. And then, depending on how the project is set up, a municipality may allow certificate of occupancy of certain units. They may say, no, you need to have, the entire building certed, and then people can move in, and so that timeline could be, completely different if you've got, eight townhomes that you're building and they can cert those as you're completing. But if you're in a 4-story building, they're probably going to want you to cert the whole building before they allow occupancy. And so on a lender side of things, that could be 6 or 8 months difference in timeline.
It could. Yeah. And there's got to be a reserve for that because you've got interest carry. And so that's kind of built into the property, and it's also built into the management of the project, and why that experience is necessary. Plus, we go outside and look at what's been happening in that vicinity, what the lease up rate is, and so on and so forth. So we have some ideas of that, but we'll research it.
Okay, so let's move on to our next topic here. What is the total project budget and capital stack? In other words, what are the costs for land acquisition, site prep, infrastructure, and vertical construction, meaning actual building? How is the project being financed currently, equity versus debt, or I guess the new equity versus debt? And then, of course, what is the borrower equity contribution? Let's touch on each one of those, because that I think is probably the number one question that a lot of these guys are going to be asking.
Sure.
How do we do this? And if I do create equity into the property, I buy it for $500,000, but I can now take it to 24 units, which takes me from a $500,000 value to $1.5 million value. Do I get to benefit from that? How does that look in the eyes of a lender?
It really has to do with the overall cost, the overall kind of investment or equity that's already in the project, and then what the other assets are that are a backup. Let's say that we have a recession, not that I'm anticipating that, but let's say that we did, and you had to carry for a long time. it's not just cash. It's what other assets do you have available that you might cash out, that you might have available in a downside scenario. So the rule is kind of, what's the upside scenario, what's the moderate scenario, and then what's the downside. And if you satisfy the downside, you're usually pretty good to go with a loan.
That I would say is probably, Rick, I think that's probably in the eyes of the lender, probably the most important, to make sure, because they don't want this asset back. They want you to be successful. They want
exactly.
They want you on the positive side of the ledger, and they want you to rinse and repeat if
right.
that was a great experience for both parties.
Right. It's what's the best case, worst case, and then what's a moderate case. And when you can answer those questions, in the worst case, there's enough backup or secondary source of repayment, then you've got a pretty healthy loan. If you have a little bit, if you're light, then we're doing a little more speculation. And that's the key is this a sure thing, or are we doing speculative lending? And most lenders don't like to speculatively lend unless there's a whole lot of back money that's available to bail you out in a negative circumstance.
Right. I think that my prior experiences looking at projects through the eyes of a lender, rates are based on risk, and even more so, with commercial lending, it's both on residential and commercial, but with commercial, they definitely dive in a lot deeper. And we'll get into that as far as recourse, non-recourse, and whatnot. So, all right. So let's hit our next topic here. What is the project return on investment, or the ROI? And this one I think is this is important for both sides. And
sure.
This is what's gonna, when you ask somebody this question, you pretty much know if they're blowing smoke or if these numbers are real. Safe to say?
Yeah. Yep. Break even is never acceptable. You got to have some profit and some return on your investment, and that number is generally about 125 to 130. Again, 1.25 times so your payment's $10,000 a month. You're going to need about $12,500 a month in income off from that particular investment in order to qualify at a bank or any institution.
Right. Sometimes they'll hear that as if it's a 130, they call that a 1.3 earning ratio.
Correct.
Yeah.
Correct.
So for every buck of debt that you have, you need to bring in $1.30.
Exactly. Yeah.
Yeah. Yeah.
That just changes, with the environment, with the location. As I mentioned before, if you've got a project that's kind of in the outskirts of Mount Vernon and there's nothing else around there, that return or that number is probably going to be a little bit higher than it is in the downtown area.
Right. Yeah, totally get that. And so, the greater the demand for the project, typically the easier it is in the eyes of that commercial underwriter to hedge closer to yes.
That's correct. Yep.
Okay. When they talk about, are there pre-leases, pre-sales, or letters of intent in place? This could come into play because each one of these folks that you and I have been chatting about, they're all going to be owner users. They're going to keep their buildings. And so anytime they can get a pre-lease, that's important. In the eyes of a commercial lender, if I have 8 townhomes,
right,
and I have 4 of them that people have said, I am ready to lease when you are done, how do you look at that as the eye of a lender?
Well, it's very favorable. And it also reduces the amount of reserve that you have to have for carrying the 4 units that aren't, pre-leased or pre-sold. So it takes less of your cash to put in place as part of the project because you already have some pre-sales that are coming through or committed to. So if you didn't have that, there's going to be a bigger reserve to carry the project until it is leased up. And so pre-sales, pre-leases, letters of intent, they're all helpful. And it can also affect, frankly, it can affect the loan to value, how much money you can borrow on that versus your own equity going into it.
I would think that that would be the biggest concern as far as a borrower, if I was looking at that. So, again, for these guys looking at building these projects and whatnot, getting that information up front and getting some front end leases would be very favorable as they're going through this. And that can even happen after the loan is in place. If things start to look a little snug, or if we're running over on time, if they're able to show that they have, hey, we've got pre-leases ready to go, we're just waiting on the certificate of occupancy or a CO, that can give a little latitude for a lender.
Exactly.
Yes? Okay.
Indeed.
All right. Okay. What are the project operating expenses and net operating income? This again is what when we talk about having a 1.3 earning ratio, which is probably for I would say a seasoned investor, somebody who's owned rental properties that are, and they're going to have some equity in this project, but they're going to want to make sure that these guys are solid on their numbers. And when we talk about that, and when we talked, we'll get into this a little bit later, we talk about an appraisal. The appraiser is going to take into this not the pie. Maybe I shouldn't say that. If the builder, if the owner has a pie in the sky, hey, I can rent these out for $3,000 a month, and the appraiser says, market value right now is $2,200 a month.
Right.
They're going to look at the appraised value.
Right. And that means that in order to get the loan, either more cash and equity has to go into it, or the project costs get cut back, but those are the ways in which you resolve for that. And any number of times we've come to find that, we're in the project, there might be some cost overruns, things that weren't anticipated. And in today's market, it's probably unlikely that a lender would step out a little bit above their loan to value. So it's going to require, again, some reserve cash or whatever to solve those issues, and or the ability to borrow on some other asset to supplement that and get the job done.
Rick, I think you just hit on a super important conversation that you and I had before, and that is commercial lending, which again, everything is negotiable. Their appetite ebbs and flows significantly with where the economy is going, what assets that bank may or may not have, what loans they already have in place. But their appetite can much like the seas, like right now we had talked, things are pretty tight this year with a lot of uncertainties, with the administration and where they're taking things and tariffs and costs and everything else. So they're kind of pulling back a little bit. Would you agree with that?
Absolutely. Yeah. It's cyclical. Real estate has always been cyclical with the economy. And as rates are higher, people the costs of construction keep going up, obviously. Interest rates are high. We've got a lot of, what shall I say, a lot of inventory out there in terms of, apartments that are being built and so on and so forth. So all of those things come into play, and what was standard, 2 years ago may have changed, and that may have gone from a, return on investment, instead of being 130, it may even go to 140 or 150, depending on the environment and what's going on in the economy.
Sure. Now, next year, the year after could be completely different, and they're saying, bring it on, baby.
Yeah. And again, George, depending on the strength of the borrower, sometimes that's really critical to all of this, because exceptions are always made, and it really comes down to, what is available in a downside situation. So if there's enough assets and funding available, banks will probably go along with it anyway. If the customer is willing to bet on sitting on a property for a year or two and has the resources to do it, the bank will probably go with it, or the lender would probably go along with it.
Okay. And that's like, so even though we talk about, commercial, oh my gosh, it's crazy and everything's negotiable and
Right.
you have a lot more steps. The benefit is there's a lot more logic. There's a deeper conversation that goes into it. Whereas with residential, it's pretty cut and dry.
Yeah. If you fit in the 9 dots, it's a go. With commercial, the 9 dots are constantly expanding.
It's a moving target.
That's right.
All right. So let's talk a little bit about the exit strategy, in which you've hit on a couple of different times, and I think that is super important. Let me put this side by side. Will the project be sold, refinanced, held for income? Why is that important to a lender?
Very simply because there's owner-occupied property, which usually is, it has different lending parameters in terms of loan-to-value, cash flow coverage. It encompasses the other assets that the borrower may have. If it's refinanced because of a lower rate, the bank wants to know how long your loan is going to be outstanding. Is it just a construction loan, or is it going to roll into a permanent when it's done? If it is, there's different fees for that. And if it's held for income, that's fine. But again, it kind of changes the structure of the loan. And when it's finished and it rolls into a permanent, we're usually looking at a 25-year on an investment property versus 30 years, which you would see on a home loan. Commercial properties, apartments, they're just less in most cases than residential. So that makes your income needs to be a little bit higher on the project to cover that shortfall of 5 years in the amortization.
Okay. So I think that is, this is the part of the conversation that most people are like, what? And that is, what is the timeline for payback, right? Because earlier we discussed, residential, normally 30-year financing, 15-year financing, it's fixed for that.
Right.
But with commercial, and this is why commercial real estate right now is the one that's in jeopardy in the eyes of most lenders. What's different about that? What would, if I came to you today,
right,
and I said, hey, I want a 30-year mortgage on my 12 units here that I just built. I want 30-year financing, and I'll do 1% or 2+ prime, whatever it is today. Are you going to laugh at me?
No. What we're going to do is come back and say, okay, you're going to get, we can do a 25-year amortization, but we're only going to have a 5-year note. So it matures and it comes due in 5 years, 7 years. Some lenders may go as far as 10 years, but what I want to share is that lenders on a house, they anticipate that, that house will roll over about every 7 years. So their interest rate risk is different than a commercial lender, which knows that a project, an apartment complex or whatever, is probably going to be held for a longer period of time. So we don't want to take the interest risk of rates going up and us basically, having our cost of money go up and losing money on it. So they make the maturities much, much shorter than you would on a residential property.
Now, you nailed something that is super important, that also I think that is important for people to understand. When we talk about an earning ratio like 130% or 1.3 earning ratio,
right?
We went from, hey, I have residential 30-year financing, and then you said, nay, we're going to do 25-year amortization.
Right.
What does that do to my payment, and how does that reflect on my 1.3 earning ratio?
It's both. In a residential situation, you may be able to borrow up to 90%, 95. That's why construction, commercial, usually is at 70, sometimes even 60%. Special purpose is actually at 50% loan to value. So it's scaled back so that there's enough equity in the project that the cash flow works at a 130 and above. And also that, the bank's loan to value is comfortable enough that if something goes sideways, they can get out of it and sell the property and still have a little bit of a buffer.
Right. So when we go from a 30-year to a 25-year, just to be clear for everybody, the bank's getting more money up front sooner.
Correct.
And that's what it boils down to. That's to them.
It is.
That's how I get more money sooner, and that makes it a little tougher to hit that 1.3 earning ratio. So that's why having a good, assets, a good project, fiscally smart project, as we look at, the development and everything else, because we know, I'm not getting 30. I'm probably going to get 25. I know that I'm probably going to have a 5-year balloon. So that's going to get into the risk. And that means you're going to have to do something after 5 years. Okay.
Right.
And depending on what the feds do, because the feds control these rates, right?
Exactly. Yep.
Yeah. So unlike residential mortgage rates, which the feds do not control, this is where the feds do control. And when we talk about prime plus, what the heck does that mean? What is prime plus?
It means that whatever today's rate is, it's a variable rate because prime goes up and down, and it's dictated in large part by the Fed, but it's a number that the banks use on variable rate financing. And that's what you have is a prime plus borrowing rate during the construction period. When it goes to a permanent loan, what you want is that fixed rate for the first 5 years and then a refinance or you reestablish the new rate at the current time. And so that's why you always want that positive cash flow, why you have more money down or equity in the project is because those things are different when they know that instead of being sold, it's going to have to be refinanced.
Right. So to be clear with everybody, when we talk about a 5 year, just like you said, every 5 year, well, if we do 5-year renewals, every 5 year, you're basically reapplying for your project and going through the whole process all over again, just like you were doing it for the very first time.
It is, with one additional comment on that. Typically, the equity has grown by then, and it makes it a little bit easier to get your loan because what started out at 60 or 70% loan to value, with the values having gone up and the payments that have been made on it, it may now be 50% loan to value. So many more people are eligible, and they're also willing to reduce the rate a little bit because the risk is less.
Right.
Yeah.
Yeah. And here's a question. Just because you have a lender that lends on you today, and at the end of your 5, 7, 10 years, let's just call it 5, that's pretty common. Well, is it a guarantee that lender is going to, lend to you again in 5 years?
No, not necessarily. And here's a good example. BECU, which did a lot of commercial real estate, is now out of the commercial real estate business, period. So they're not doing anything. So if you have a loan that's coming due or is maturing, you got to take it somewhere else because there's no guarantee that they'll renew it at all.
And that takes time.
It does. Yeah. Then you're shopping again and going through the process and yeah.
Okay. All right. Let's start our next chapter here. Here we go. What is the market analysis and demand justification? Is there a market feasibility study? What are the current market trends, vacancy rates, absorption rates? Who are the competitors, and how will this differentiate you from everybody else? Now, this is a recommended. Answer these questions as far as your proposal to the bank, because they're going to want to know these answers, which will also help your appraisal.
Right.
On the scale of 1 to 10, 10 being extremely important, how would you rate these answers in the eyes of a lender?
They're pretty high. It kind of goes back to what we talked about a rural area of development versus, the downtown situation. And the feasibility and the market, is the market hot? Is the market slow? Is this new to the area? What are the carrying costs? It all affects the loan to value and the cash flow coverage and all of that stuff. So all of that is done ahead of time, oftentimes by an appraiser, market study, but most builders or people that are developing or want to develop, they're going to find that information out ahead of time so that they don't end up stuck before they even come to the bank or to the lender.
Okay. All right. Let's hit the next one. I think you hit that one pretty well. Hang on a second. Let's make sure we got all of those. What are the current market rents vacancy? We talked about that. Who are the competitors and how will this project differentiate? That is, I would say that is an important question to answer. Probably secondary really to the second one, which is what are the current market rents, vacancy rates, absorption rate? Are we in a starving market? Or are we in a, overabundance of rental homes? I think that would probably be the most of those three important to the lender. Competitors, yes and no, right? Feasibility, that definitely is something we're going to take a look at. If you're doing smoke and mirrors in your feasibility and you're creating doubt, that's just absolutely the worst thing you could do. You really need to make sure that your pro forma is solid for rental numbers and true projections. So, all right. Okay. So
and let me add to that as well, George, just because there's some things that a borrower will want to know about that process. And number one is the bank or the lender always picks the real estate appraiser. It's not picking their own. So when you're getting ready to do a project like this and you're talking to the bank will say, well, we need an initial proposal, which will sort out some of that stuff. They go into the zoning, they go into the county, they find out what's going on. They give you market information and that kind of thing, how long it may take to lease up or rent up and those kinds of things. Those are all decisions that we see in the underwriting in deciding whether or not a loan is going to be made. And then there's the follow-up as built appraisal, which is done later. They just update that initial one and say, okay, it took 8 months to build or whatever. These are the things that have changed. And now this is what the market rent is worth based on. So we have basically the first appraisal that gets paid for by the client. And then that's the as is, and then the projected and the as built, which is at the end. So just wanted everybody to know what to expect that way.
Okay.
But
I think that's absolutely solid. And there are multiple appraisals during this process.
Yes.
The one that starts, and then of course, once you get permanent financing, to make sure that everything is consistent. And, was it as originally projected? Is it better? Is it worse? And,
right.
And if it's worse, they may be required to provide additional assets or additional collateral.
Exactly. Yep. Yeah. Yep. Absolutely. Because the loan to value will actually go down, and it's got to be supplemented somehow.
Right. So, and it's just again, it's on one side it's super simple because it has to just meet certain criteria that says here's my debt, here's my income, here's the rentability, and here's how this kind of looks as a package, and they get the thumbs up, thumbs down.
Right. Yep. Absolutely.
All right. So if we pop on to our next one, we already did that. Hang on a second. Let's move to our. Let's see. What are the construction and development risks? Naturally, a lender and a borrower are going to want to know these things. It's super straightforward. Really, making sure we know that subs can make or break a project.
Yep.
Right. If you get, we've all heard of, class action lawsuits because they use the wrong P trap, or the siding didn't get put on correctly, and now we got an issue, right?
Right.
Did we have bad, groundwork, and did we shortcut any of that process? Those are all concerns that, a bank's going to look at to make sure that, hey, yeah, you may have the financial wherewithal, but at the end of the day, are the people you're working with solid? Is the person that's building this for you, are they solid, right?
Right. Which is why lenders, and not all, but the majority of lenders will want to know who the contractor is, what their history is like, what their credit rating is like, because sometimes contractors are not necessarily notorious for, being in business forever, because their businesses go up and down, as does the economy.
Right. How many times have they changed company names to, start a new one? So, having basically their contractor will have to provide a resume, and then of course they do a background on these guys. Hey, can they do this, right?
Right. So, and then the lender also does site inspections at different intervals before they release money in the construction phase, and to ensure that, things are done, and the contractor reports to the bank on certain things that, okay, we're at this stage and this is done, and then they can get money.
Right. Yeah. Which is another important thing that, that the contractor, needs to know, is that, hey, just because you request a draw, that doesn't mean that draw is coming the next day.
Exactly. Yeah. Lots of checks and balances. Yeah. Lots of checks and balances.
Yes, and so, which at the end of the day is a good thing, because, like you say, it keeps everybody honest, and it's designed to protect the borrower. So,
well, and the most important issue is getting that occupancy permit. And if we miss something, that isn't coming, and that costs you money. So that's why it's so important to have these steps in process.
Yep, absolutely agree. All right. What is collateral value? We've talked about that a few times. What is the we talked about, we're doing value add to the land, taking from single family to multifamily, or small commercial. And then let's talk about that first, and we're going to talk about an appraiser, and what shakes out there.
Sure. Yeah, so I think you mentioned that sometimes these are houses that will be demoed, and then subsequently, you've got raw land in which to build on, and the zoning, the permitting, all that stuff is taking place, or can take place. Some different counties take longer than others, as you know. But once all that stuff is done, go back to your question. I wanted to see all three of them so I can answer it kind of in a.
Yeah, let me pull that up. There we go.
Yeah, so the as is and as completed, we talked about that before. The appraisers always have to be an MIA appraisal. And then the loan to value is really subject to what that appraiser is telling us it's going to be worth as completed. So that's your first appraisal, which says, here's what it is today. We've got your plans. We looked at this. This is what it should come in at the end, if everything is built according to your plans and budget and all that other stuff. And then that's how we come up to your loan to value, that the bank or the lender will actually give you in terms of money. So if it's specialized, like I said, it can be as low as 50%. If it's not, usually on multi-units, financing goes, I've heard that they'll go up to 70%, sometimes even 80%, but it really depends. That's more on apartments and location and that kind of thing.
Right. It's just so many variables come into it, depending on, like you say, location, style, demand, and to make sure these guys understand, you have an appraisal in the beginning saying, here's what we project. And then they have to have, for their conversion financing, they have to have that other appraisal on the backside. And that's not a broker price opinion. It's an actual, you get to pay anywhere from $3,500 to $7,000 for an appraisal, depending on complexity. Does that sound about right?
Yeah, right. And
So,
it also depends on the market values. So let's say that you want a very fancy apartment building or project or whatever it is. If it's out of character with the market, the loan to value is going to go down. So, in other words, the surrounding area doesn't dictate that. You're doing the Ritz-Carlton type of project. It's going to be different than if you're doing, so those are all concerns. But there again, it comes back to equity. And if you've got enough equity in the project, it's not going to be a problem.
right. Money talks, BS walks.
Amen. And borrowers want to know that ahead of time, because the worst thing that can happen is you get a project that either doesn't lease up and it's costing them money on a monthly basis, or they can't get the loan to value that they need and they're not prepared for that. And, something can go wrong. So that's part of a lender's job, is to help them figure that out way before they even get into it.
Before we run into a problem.
Yep.
All
Proactive.
Right. That's right. That's environmental concerns. So a lot of this is going to be very new to a lot of new investors, because they're going to say, just like I did, right? Say, when I first came, you're like, hey, do you have your phase one? I'm like, phase one? We're still breaking ground. What do you mean? We only have one phase. We're going to just build it all at once. You're like, no. A phase one environmental site assessment. And you're like, what? What is a phase one, Rick?
Phase one is a high level examination of the ground. So here's an example. If there's a house on the property, it's demolished, the ground is level, and it looks like it's ready for construction. But you have to do a phase one investigation to find out if there's an oil tank still left in the ground, if there's running water from up the hill that's coming in an underground situation that ultimately could destroy the property, if there's been gas leaks, or if there's a gas station nearby that could affect this property. All of that stuff has to be done by a professional to sort out any kind of liability for not only the lender, but also the client.
Right. Again, it's a protection for all parties, and and occasionally things do come up, especially your classic example. The gas station. Some folks, they say, oh yeah, that gas station's been vacant and boarded up, for 5 years.
Right.
Probably because of contamination issues or certain issues that banks just don't want to touch, or they have to do so much remediation that it's cheaper just to let it sit there. So, are phase ones required on all commercial loans?
I think they start with a phase two. It's actually backwards. The phase two is the lightest of the two, and then it goes to a phase one, which is more technical. So, for example, if you're taking down an old house that had asbestos in it, it could be in the soil. If they find it's in the soil in one spot, you're probably okay. If it's spread over an area, they may end up requiring a stronger phase to investigate, was it coming from underground, or it's just left over from the demolition of the house?
Okay. All right. And
what that means is you're digging deeper.
It's cha-ching.
Yeah, exactly.
So having, doing all of that testing and whatnot up front is important, because it is I've always known it to be a requirement. Even when we are doing a refinance, they will use, our phase one or phase two report. Right. They just say, as long as you have one and nothing else technically has changed on the site, they'll reuse that report. Is that still the same that so far?
If there haven't been any changes to the site, yes. But if there have, or if it depends on how old it is, sometimes it has an age limit on it, then a lender will request a new one anyway.
Okay. All right. let's hit the next one here. Here we go. All right. When we talk about infrastructure, naturally this goes into part of the evaluation of, is this a viable project? And I think this is really also just classic to when you talk about, hey, is it more rural? Are we in Mount Vernon? Or are we in downtown Seattle or Everett or Tacoma?
Right.
Those services and that cost and that infrastructure cost is a huge element of this. Would you agree?
Yes, because if you're piping natural gas from Mount Vernon, 5 miles out, it's going to be a lot more expensive than it is, if there's a pipe running down the street, you just have to tap into it. So yes.
Okay. Let's see here. So as we let's see here, who bears the cost of extending infrastructure? That's naturally the owner on that one. All right. I included a little image from today. It says CRE loan performance deteriorates, heightening concerns for lenders and investors. The biggest question at the end of the day that I would say is probably the most important to lenders really is, hey man, how are you gonna pay this, and what's that gonna look like? And then of course the last thing we'll conclude with is recourse or non-recourse. So let's talk about the eyes of a lender, having that whole spectrum of 1.3 earning ratio, the making sure that we're staying within cost allocations for construction. Lastly, dude, how are you going to pay me back?
Right. And so that starts at the very onset, and it's known as the strength of the borrower. And the project ideally will be the source of primary income, but banks always look at secondary sources of income or secondary sources of repayment, which are other assets, cash reserves, things that if everything went to heck in a handbasket, there's a way out. And, the devaluation of property is not all that unusual in certain circumstances. In a recession, for example, we saw that back in 2008, right? And so the question becomes, are there extended resources available that will cover that shortfall? And if there's not, then you may not be making that loan. And then there's what's called tertiary resources, which is basically you're liquidating the project and you're going to court to get the rest of your money back. And we've got to look at all that because there are downside cases. It doesn't mean everybody's going to do it, but for safety purposes, lenders want to know that, so what's the best case scenario, what's normal, and then if everything goes to heck in a handbasket, how do you get out of this loan? Because banks loan money and they get money back. They don't want to own assets.
Right. I think that's a super important message you just delivered. They don't want assets. They just want money.
Yeah. They loan money. They want it back. And the properties and the assets that are being financed belong to the person that, and they just, the bank and the industry wants to know that they have the resources in which to settle that debt.
Okay. We discussed a little bit earlier about recourse versus non-recourse. Some guys are probably just scratching their head. What does that mean?
Recourse means that you guarantee that the cash flow is there, that the property, you can take care of the property should everything become Armageddon, and then you're responsible for it. Non-recourse means that the bank is taking on the risk of the project based on the high income to NOI, the collateral value. So if you're at 50% loan to value, there's a better chance it's non-recourse, because if we did take it back, we'd have a lot of equity into the project. So it depends on the borrower, it depends on the project, it depends on the equity in the project.
Okay. So there's a lot of facets that come into that, but that's something that people need to answer. It's not like, they get a residential loan, and if they lose the home, they don't go after them for more. That was the collateral. If they have a recourse loan, they could, if they lose their project, their
Yes.
house, their other investments that they had put on the plate as far as collateral, that becomes, well, at risk.
Yes. Put a different way is you're guaranteeing the bank repayment in one form or another, no matter what happens. Right. And non-recourse means that the bank has eliminated that need for you to repay it if something happens. So those are the two differences.
Yep. All right. Fair enough. Okay. So, Rick, we've been through 13 different things that banks want to consider that will help a lot of the folks listening to this call understand a better idea of kind of the mindset of a commercial lender. What folksy wisdom would you offer to anybody coming into that is new into the system? What would be the top 3 things you would recommend them doing up front?
So if they haven't had experience in this area before in construction, it's to gather as much information, talk to people that have done it before, find out what the downfalls are. What can go wrong? What do you do if it does go wrong? Basically, be prepared. And then the other piece is if you can meet the criteria of lending, you always want to make sure that you have more than enough so that if you get a cost overrun, if something comes along, that it doesn't shock you or stop the project. That's never fun. Sometimes they'll find something along the way in the construction process that isn't going to work, or the county comes in and says, you got to fix this or change that, or you need a fire hydrant that's closer and it's not where it needs to be and you got to pay for it. You've got to have those resources available. And those are really the 2 things that I think are the most critical, because money fixes a lot of different problems. Resources fix a lot of problems. And then the last one is being very comfortable in the market, that there is a need for it, and that, enough people around you and in that area are telling you, this is going to be a very profitable venture based on what we know and what we see and what's happening around us. So in other words, I happen to live in Edmonds, and light rail is a good example. Wherever the light rail is going, if you're putting an apartment or homes nearby, they're more valuable than they are if they're further away in Mount Vernon. I keep saying that, but those are things that matter. So you're taking more risk in a Mount Vernon project than you are when you're closer to the infrastructure. And that's where values come from. Yeah.
Okay. I think those are 3 great points. Commercial loans, and even though we're having the hard conversation today, at the end of the day, working your project, making sure that, hey, you're designing and building and making something that has high desirability, making sure that, you're building a really good resume, and you got, some really good folks that are going to, help you do that construction. Very manageable, happens every single day. It's no different when you buy your first home. It's always scary, and it's just one of those things. And having somebody like you on the backside, to be there to help consult and give feedback and give some guidance, and be that little lighthouse with showing the way is super valuable, and that's why you're here. So Rick, my friend, as always, it has been a pleasure. All the best to you and your family, and I just want to thank you for coming in and sharing your wisdom with us again.
George, anytime, it's a pleasure. I do want to leave you with one word for you and for your clients or anybody that you're talking to. Success comes from reverse engineering. And by that, I mean going out to the end of a project and looking at it and then reversing engineering so that you're going through each one of the steps and the problems that could potentially come up as you're doing it, because that way you avoid problems versus going into it and finding out that you get stopped at one particular stage because the county doesn't like something. That's so critical.
Right. I 100% amen to that.
Okay, my friend. I
All right.
appreciate you, and let me know whatever I can do to help you at any time.
I appreciate it. In the meantime, you guys have an absolutely beautiful time. Rick, I will be chatting with you later. Thank you very much.
All right. Have a good one.
You too. Take care, everybody.
Bye.